ready to take your investment game to the next level? Introducing Digital Investor, your ultimate guide to mastering the digital marketplace. Whether you're a seasoned pro or just starting out, Digital Investor brings you cutting-edge game theoretical strategies, expert insights, and real-time tips and tactics to analyze, evaluate, invest, and grow your wealth. Don't miss out on the digital revolution. Visit www.nickblacknext.com and start your journey with Digital Investor today.
All right. Let's go to the orange screen. That's a good one. Let's put it. All right. Okay, so let's see. What do we got going on? Well, today we're going to talk about the interest rate illusion, the interest rate fallacy, because so many people, man, you can't look in any direction and find people that really get this. So we're going to talk about that, and we're going to talk about expectation theory and how stupid that is. Yeah, and maybe some cognitive biases associated with those things. All right. Talk about a few of these things. Get some more palm trees in the background. Yeah. Hooray, palm trees. All right. So that's kind of where we're at. And then if any questions you guys have them, ask them. And we will tackle that stuff as part of office hours, because that's what we do. Okay. We could take a really quick look at markets, couldn't we? We could. Let's go over here. Bam. Bam. Ooh, market almost 4 trillion on the total. That'd be cool. That'd be really cool. So if Bitcoin would get out of its own way a little bit and start moving and stop being a little bitch, get back up to about 123, then we could do something. Right now we're just waiting. Ethereum over 4,400, so that's cool. The grind, hello. The grind upward, nice. Let's see. Any other showstoppers? Everything's pretty quiet. Oh, Matic finally came back down after its stupid pumpy bullcrap jump. Yeah. A pig is a pig, my friends. Yeah, who knows? Maybe with a little bit of luck, in a few days, we'll be staring at 4 trillion crypto market cap. That'd be cool. It's probably about 1/4 what it should be, but it'll still be cool. Conan, what's up? So yeah, that's where we're at. Okay, let's see. Yeah, okay. Yeah, everything's pretty cool. Tom Lee raising more money for was it Bitmine or whatever? Just I think he's going to look at trying to get $20 billion now to go buy more Ethereum. All right, that's good. We'll take it. It looks like CPI was pretty soft. I mean, I can go through those numbers, but it was pretty remarkably soft. And again, if you take out owner's equivalent rents, which is the the nonsense part of it, it would be even lower. Consumer prices rise 2.7% annually in July, less than expected amid tariff. Again, the tariff worries those aren't tariff worries. Those are stupidity worries. Those are people that don't understand how math works and they don't understand how economics work. So when you hear that, just dial that crap out. Anyway, widely followed measure of inflation accelerated less than expected in July on an annual basis as Donald Trump's tariffs showed mostly modest impacts, almost no impacts. Isn't that interesting? CPI increased a seasonally adjusted 0.2% for the month and 2.7% on a 12-month basis. The Bureau, BLS, which now is run by somebody else because the person that was running it before is fired. So that, and I'm not going to say because it was a DEI hire, it was bad. The BLS numbers have been garbage for a long time. And you even have people that are pretty competent that support that, which is really when you know that people are being political and they're letting their political beliefs get in the way of common sense. Because anybody that supports a bad number on a regular basis is a fucking idiot. And that's the end. And that's the nicest way you can say it. So anyway, the CPI raised, 0.2% for the month, 20 basis points, and 2.7% on a 12-month basis. That compared to the Dow Jones estimate for 0.2% and 2.8%. So this is below the Dow estimate. Excluding food and energy, again, food and energy are the things that people buy, but whatever. Excluding food and energy, CPI increased at 0.3% for the month, 3.1% from a year ago, compared to forecasts for 0.3% and 3%. Federal Reserve officials generally consider core inflation to be a better reading for long-term trends. Well, what they Fed officials consider any number that they're right about to be the right number. Whenever the number goes against them, they just guess. They just say that those numbers that data is no longer sufficient. It's no longer good enough. The data is never good enough if it doesn't say what the Fed thinks we expect the Fed to say about, and we're going to talk about this. Their bullshit expectation theory that has no basis in reality. Their misunderstanding of what inflation actually is. They're just anchored in bullshit. And then when the numbers don't work, they just switch the number. They just look at different numbers. They're just like, no, we don't look at the 210 anymore because it just doesn't agree with us. We don't look at the yield curve because what do people in the market knows? Dumb traders, those bond vigilantes. That's bullshit. Anyway, good old empty suits at the Fed. A 0.2% increase in shelter costs. Again, that's the weirdness of the owner's equivalent rent survey, which is stupid. But anyway, a 0.2% increase in shelter costs drove much of the rise in the index. Meaning you take off the bullshit part of owner's equivalent rent and all that, and you probably get a number well below, it's already below, but well below what the street was expecting. And again, throwing more water on the here comes inflation fire. Tariff-sensitive new vehicle prices were unchanged, though used cars and used trucks saw a 0.5% jump. Well, I guess that makes sense, right? Like if you can't afford a new one, maybe you go and you buy a used car. I think there's pretty good used car market. I don't know. Hard to say. Transportation and medical care services both posted 0.8% moves higher. Transportation, that's interesting. Transport, you could probably dig into that. Medical care services. I don't see a direct corollary with tariffs, but anyway, I'm sure someone will make that argument. But I don't think it's a good one. Stock market futures posted modest gains. Treasury yields were mostly lower. Okay, all right. Tariffs did show up in a few categories. Household furnishings and supplies, because that makes sense, showed a 0.7% increase after rising 1% in June, so it's slower than June. However, apparel prices were up just 0.1%, and core commodity prices increased a very modest 0.2%. Canned fruits and vegetables, which generally are imported and are also sensitive to tariffs, were flat. So one of the White House economists said, the tariffs are in the numbers, but they're certainly not jumping out hair on fire at this point. This was Jared Bernstein. So he was a former. So this is even a Democrat who would love to be able to pin a bunch of shit on Donald Trump. And even a former Democrat can't find that inflation everyone's talking about. The report comes at both critical time for the economy and the BLS itself, which has come under Trump's criticism for what he has charged as political bias. I don't think it's political bias. I think it's stupidity. I think it's a poor way. The way they measure is poor. The respondent statistics are poor. Like when they put out these surveys, I think only 60% or less of those surveyed even respond. That's not a good number. So then they do this kind of bullshitty smoothing guessing thing, and then they go back and revise, and the revisions are always way down. Sometimes the revision is all. And when you have numbers that are that bad and they've been this bad for decades, why do we use those numbers? It's so stupid. It's so, I don't think it's political. I think it's stupidity. It's bad data, bad collection process, and a bad organization. So good that he fired that individual, which we don't even know no one even knows what the gender of that person was. It was a DEI hire. It was a Pat. No one knows. And it probably wasn't Pat's problem, right? But if Pat's running the show and the show is terrible, I guess it does fall on Pat's feet, whether they were sneakers, slippers, stilettos, hard to say. Okay. Let's see. The main issue is whether tariffs will cause one-time price increase or lead to lasting upturn for inflation. Economists and Fed idiots, the empty suits of the Fed, they tend to believe that it's a lasting upturn for inflation, right? Even though a one-time price change, it's in the sentence, a one-time price change. So you go, okay, well, that's not forever. It's not like there are new tariffs every single month. It's just kind of bullshitty and stupid. Anyway, have you heard of a plan to merge BTC and treasuries called bit bonds? Well, it's not merging Bitcoin and treasuries. I don't think. I think it's bonds on Bitcoin. Although maybe there's some weird new chimera. So no, I haven't heard of a plan to merge Bitcoin and treasuries. You can have Bitcoin backed treasuries. Maybe that's what you're saying. I think that's what you mean. Okay. Anything else on that? Futures market is pointing strongly to a Fed rate cut in September. However, a raft of data between now and then could influence both the decision for that meeting and central bank's future course. First of all, the Fed's not a central bank. They don't deal in money. In order to be a central bank, you have to deal in money. They don't deal in money. They deal in bank reserves and interest rates. Interest rates aren't money and no one follows them. And bank reserves aren't money and no one spends them. You can't. Federal officials as of late have been expressing increasing levels of concern about the labor market, which would bode for rate reductions. Yes. Traders increased the implied odds for a September move following the release and put the chances of another reduction in October at 67%, up from 55% the day before, according to CME's FedWatch. The CPI is not the Fed's primary inflation forecasting tool. The central bank uses the Commerce Department's Personal Consumption Expenditures Price Index. However, The CPI, as well as the Producers Price Index that will be released Thursday, feeds into that calculation. So again, when they don't get the number they want, they just go search for another data point that will be closer to what they've said the numbers are going to be. It is all political theater. It is all talk show. It is all bullshit and whimsy at the Fed. There is nothing going on there that you know. It's like a first year college economics course, and they got out and they're like, let's go run the country. Like, oh man, should we touch the bullish IPO? I'm not messing with any of that crap. Does anybody use bullish? Anybody here use bullish? I thought that's what you said when you're trying to say bullshit, but you don't want to cuss. Oh, that's some bullish. Does anybody use it at all? So how would they be worth $5 billion? They're pricing around 4.9 billion or 5 billion. No one fucking uses it. So, I mean, I guess good for them if they can get the money, but who is using bullish? That's some bullish. So yeah, that's it. That's all there. Let's see. I think they did an inflation breakdown, and on that one, okay, yeah. Food at home plus 2.2%, and that was eggs up 16%, still 16.4%. Roasted coffee 14.8. That makes sense. There's not a lot of coffee being grown here in the States. Beef steaks uncooked 12.4% on the plus. Ground beef 11.5% up. Candy and chewing gum, no one cares. Juices and drinks 6.8% up. Apples 6%. Frozen fish and seafood 5%. Bacon, oranges, bananas, cookies, chicken parts. They just say parts. Parts is parts. Olives, pickles, relishes, dried beans, peas and lentils, canned fruits and vegetables, all below 4.6%. Let's see. Food away from home at employee sites plus schools up 7.4%. From vending machines up 5%. Full service meals and snacks up 4.4%. Let's see. Energy. It's got energy. It shows energy down like negative. That can't be right. Negative 1.6% from, I guess, from the prior month. Utility, which is pipe, gas, and services, up 13.8%. Electricity, 5.5%. So those numbers are coming down apparently. And then all items less food and energy is all items are up plus 3.1%, less food and energy. And that's college textbooks, audio equipment, and motor vehicle repair at the top of the list. Cigarettes are at 8%. Furniture, 7.6%. Delivery services, 7.6%. Window and floor covering, 7.2%. Nothing really interesting there. Everything else below 7%. In July, grocery and gasoline prices declined or deflated, you might say, by respective 0.1% and 2.2% on a monthly basis from June. Economists continue to look at this data that strips out food and energy. They do that because those numbers tend to be very volatile month by month. The so-called core CPI figure had been rising in recent months. It rose 3.1% in July from July 24, and that's up 2.9%, a 2.9% annual pace in June. It's the fastest annual rate for core CPI since February. We expect it will rise further to a peak of 3.8% by the end of the year as tariffs bleed through. This is another chief economist. They keep expecting these big numbers, expecting expectation theory. That's why that's what we're going to talk about today, expectation theory, and how fucking stupid it is. These guys are idiots. And it's mind numbing because I guess when you become an economist, you no longer do research. You just grow one of those weird beards. You wear those round rim pedophile glasses, and you go give speeches, and You probably wear tweed or plaid. You probably have a little, you definitely smoke a pipe. You wax philosophic about interest rates and how stupid the retail investor is and how you are smart. You never invested in silliness like cryptocurrency or technology, AI, none of these. I never invested in technology. I don't believe in it. It's a fad. Bring me my whale oil. You guys are such clowns. I'd love to hang out with an economist and just shit talk him until he just quit life. Anyway, inflation, most evident for consumer goods. Tariffs are, as we know, a tax placed on imports paid by U.S. companies that import the goods or services. Okay. Businesses generally pass on those higher costs in part to consumers, and in part they'll absorb what they can to maintain consistency in market pricing. But again, economists will have you believe that all of that gets passed to the consumer, and it just creates prices just get out of hand, and then consumers panic thinking, oh, this is going to be forever, and then they push up prices by running out and front running purchasing. So there's a place called the Budget Lab at Yale, and they estimate average households will lose $2,400 in the short term as a result of tariffs. And I'm sure they have a lot of very econometric ways of coming up with those calculations. And most of those people will never get a job in the real world, and they will die mostly penniless with a bunch of student debt, if I was to guess. They will probably each owe way more than $2,400. Tariff effects are most apparent for goods prices, like those for household furnishings and apparel, except that apparel didn't really go up. Of course, inflation for core goods, which strips out food and energy, was up 0.2 in the last 2 months, according to CPI data. In more typical times, goods prices are generally flat or declining. That they're on the rise is clear evidence of very mild tariff impact. Yeah, I mean, the rises, right? They're on the way up, but they're on the way up so minimally. Household furnishing prices were up 0.7% on a monthly basis, according to CPI data. Annual prices were up a more muted 0.1%, and toys 0.2%. Well, it's good. As long as kids can buy the toy, well, I guess parents. As long as parents can buy their kids toys. Video games are so much better. They're probably not. They're probably terrible for your brain, but they're probably good for not having to buy stupid toys that kids. Man, I get a new toy. After about a week of playing with that thing, I'm like, I'm over it. This G.I. Joe bores me. Anyway, there are clear signs. A range of good prices are moving higher, but those prices are very minimal, pushing core goods inflation up. But some major tariffed items, including automobiles and major appliances, have yet to show any impact. And this is from an economist. Steve Miron, or Myron, it's hard to say, chair of the White House Council of Economics Advisors, said on Tuesday that CPI data shows no evidence whatsoever of tariffs, or that tariffs have fueled higher consumer prices. And I mean, the data is with him. The full effect of tariffs is still unlikely to be felt for several months. And that's the good thing if you're Jerome Powell, because you can just keep telling everyone, just wait. You just wait. Those tariffs, you just hold, just everybody wait. Just keep waiting. Tariff uncertainties, just wait. And he'll say that until he's fired, which is, he won't get fired. He'll just go away. I think he becomes a lame duck. I think once the new, whoever's going to replace him has been voted in and all that, I think Jerome Powell becomes a nothing. I think he's just a diminished nothing, because then what we'll want to hear from is the new guy, not the old guy. Old guy will just be, see you later, bye. Yeah, I mean, I've heard of bullish, but I've never used it, not even considered using it. And I think in crypto, 2 billion in volume a day, it ain't really all that. I bet Binance does 100 times that. I just don't think bullish is anything. I think Peter Thiel has a lot of friends that will follow in whatever he does. I think he is a smart dude and he knows how to make money. And a bunch of people are not as smart as him and they'll give him money. And then and bullish will just disappear into obscurity and we won't really talk about it again, except every now and then when they do their little quarterly filing and we hear that bullish is down 17% from its IPO price. That's pretty much all we'll get. Okay. This isn't a 1 month event, said Sarah House, a senior economist. Okay, here we go. Senior economist at Wells Fargo. The impact will be dragged out over many months as businesses are waiting to see where tariffs settle. Really? April, May, June, July? We're in August? They're waiting to see where things settle, huh? No. Businesses are trying not to lay people off, and they're laying people off. That's what's going on. Most of the rest of this is just economists embarrassed that they've been wrong. I mean, their whole career. I mean, imagine that if you were an expert or so-called expert in something and you had been wrong your entire career. Everything you've ever said was wrong. That's embarrassing, right? Like at some point, even your own kids look at you and you're like, listen, kid, they're like, shut up, you old bag. You don't know what you're talking about. Even mom laughs at you. He's like, she does not. And he turns and she's sitting there and she's like, yeah, no, we do. We all laugh at you because you're a clown, because you live in a fake world of fake numbers that doesn't exist. And your fake numbers don't describe the real world that we live in. Fake number economists. Anyway, I'm not going to read anything more when it says so-and-so economist. I'm not going to read anything more. But let me see. Jerome Powell. It's been a very dynamic time for these trade negotiations, but we're still, a ways away from seeing where things settle down. Well, of course you are, Jerome. By the time things settle down, you're out of a job. Let's see. There is some evidence that the Trump administration's policy around immigration is limiting the supply of immigrant labor in certain sectors of the economy, which could put upward pressure on inflation in those areas. Although you might say those are areas that were unnaturally kind of supported by low wages, borderline slave wages paid to immigrants. Don't you think that's kind of shitty? I don't know, man. If immigrants are here, pay them what you pay everyone else. If you have an immigrant problem, solve the immigrant problem. But humans should get paid for their work. A human over here and a human over there should get paid the same if they're both humans are doing the same amount of work. One of them's illegal, book them. Otherwise, pay them. Book them or pay them. Pay them and book them. So we'll see. Anyway, that's all we have on there. By the way, the S&P apparently is at an all-time high or right near an all-time high. Record high. So you'd say, hey, look, the whole world is in the throes of a recession, but the stock market's at all-time highs. Yeah. Rejoice. So stupid. Boy, we live in a weird world, don't we? No wonder people are pissed. Wouldn't you be pissed? Wouldn't you be angry as hell? If everybody's telling you everything's fine, and 2%, 1% of the people are super rich, and everybody else is getting just stepped on. They're just getting grinded, and they're working their asses off for like something very minimal. I don't know. It just seems sketchy. We live in a backwards world where a fake market, the stock market is a fake market. It is not real. It's just a handful of people, a handful of kind of marginally lucky people investing money that no one else has in a little vacuum that just vacuums itself higher and higher, regardless of the world around it. Isn't that weird? Don't we live in a weird world where it's, I don't want to say it's unfair, but it's not balanced. Fair and unfair, those are weird kind of human, creations. But is there balance? No. So you just want to be on the best side of it. Okay. If you guys don't have any questions, why don't we get to the guts of today's discussion? Let me find what's a good. No, we don't want that one. It can't be accessed. We don't want that one. It's a good one. Oh no, that was LTV. That's not really what we're looking for. I had some good artwork. Perhaps we don't have any good artwork for. I bet I could make one. Should we see what GPT comes up with? Let's see. Okay, I need. Let's see. Can you get me a piece of artwork that shows this weird struggle between expectation theory and the interest rate fallacy? Let's see what we get. It's very exciting. This is very exciting. Hold on. What do we got? Okay, it's getting started. Image is being produced. Oh, it's very exciting. And then I'll put it on the screen. I haven't tried any images with GPT-5. This is the first one. This is all we've got so far. You guys with me on it? This. So far, it's just this. Glimmering pastel monsters. I don't know. Who knows what's behind? Who knows what's behind door number gray? Come on, bro. It's adding details. Well, yeah. There ain't nothing else. So the details all we got. Oh. Hold on. Let's do this together. Ooh, so look at this back and forth fight. Look at this battle. Look at this psychological brawl. Okay. This is pretty cool. Okay, all right. Let's see if we can get this. Okay. Let's see if that worked. Did it? What the shit is that? Let me get back here. Yeah. Okay. It put it in a weird place. Let me go back. Let me get it smaller. Anyway, there we got some artwork. That's a very weird. It's very weird that it put it right there, right? I wonder if I can plus it. Can't really move it. Okay, well, you know what? It is what it is. It did it. It's weird. It did it as a website instead of as a picture. But you know what? Fine. Okay. We're going to talk about this now because this is a good one. And this is something that you guys need to put into your brain boxes.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Hello. You're late.
How'd you like to show up for class and and that's your, well, you know who that was? That was the head of the BLS that just got fired. That's he, she, or they's new job. There's not a which model of GPT-5. That's not how GPT-5 works. GPT-5 is GPT-5. All right. They condensed those models. Then there's just many models. If you have a regular service plan, there's many models when you run out of minutes or whatever, but GPT-5 is just GPT-5. There's just smaller models. If you get bumped, if you're on the freebie plan, you get bumped after you've used a certain amount of volume of capacity, whatever they call it. Okay. let me get us started. We are going to discuss, well, a couple of things. The first one is the interest rate illusion, right? How economists continue to chase shadows. They keep chasing shadows. So we're going to start with something that sounds very obvious, but maybe is not so obvious. And that is the statement: high interest rates mean that the central bank is fighting inflation, and low interest rates mean that they're stimulating growth, right? That's what you hear. Low interest rates stimulate growth. And this is what economists say. This is what the empty suits at central banks say, Fed idiots. This is what morons that read off teleprompters on CNBC and Bloomberg say. It's what most people say. And frankly, just about every direction you look, this is what people are going to say. High interest rates mean central banks are fighting inflation. Low interest rates mean they are stimulating growth. And these morons believe this. Milton Friedman called this the interest rate fallacy. Like, it was so prevalent that he had a whole fallacy, a whole cognitive bias just based on it, which should tell you something right there. Friedman's point was simple, but pretty devastating, right? Interest rates don't tell you the stance of monetary policy. They tell you the aftermath, right? Interest rates are after the fact. Does that make sense? Policy is after the fact. It chases the market. Low rates are the result of a long period of easy money that already caused the economy to slow. Why? Think about what low rates mean. And we got to think about bonds just for a second. The price of a bond and the interest rate attached to it, the yield, is like a seesaw. It's inversely proportionate. So if a bunch of people are buying bonds, okay, a bunch of buyers means the price is going to rise, right? Because there's buyers in the market. So they're competing. So as people buy bonds, the price goes up. What does that mean? The interest rate, the rates on them, the yield goes down, right? If people are not buying bonds, what happens? You have to entice them by raising rates and lowering the price. That's small e economics in the bond market. That's how it works to peddle your bullshit government debt. So low rates are usually the result of a long period of less expensive, easy-ish money that had already caused the economy to slow, or they are the result of an environment where people are hiding in government debt because they do not want to participate in the economy. The stock market, all-time highs today. Every central bank on earth cutting rates. Do you see a problem there? The world is lowering rates. Why? Because they're chasing a market that's lowering rates. Why are the rates low? Because people are hiding in the bond market. Why are people hiding in the bond market? Because the economy is a piece of shit, and they're not lending. They're not participating in those, the animal spirits, those, the entrepreneurial endeavors. They're not funding projects. They're not doing shit. Instead of lending, they're buying government debt and hiding in the safe, liquid markets. Safe, liquid markets. High quality, or as high quality as you can call it, right? Safe, liquid markets where they can take collateral and they can grab some yield on it, and they can relend that collateral and then grab some yield on that, and they can do all their business in repo and never touch Joe's six-pack, right? On the other side of it, high rates often follow a period of tight money where inflation has been tamed. Again, this is somewhat flawed. Think about it like in game theory terms, it's a signaling problem. Economists and markets are reacting to the wrong signals, right? Like a poker player who watches their opponent's facial twitch instead of their stack of chips. Okay? So Friedman's interest rate fallacy, the core idea was interest rates are the outcome variable, not a policy variable. Does this make sense? Again, they're the outcome variable, not the policy variable. So by the time you see high nominal rates, inflation expectations may already be falling. And by the time you see low nominal rates, growth may already be weak. High rates are indicative of an environment where people are not buying a lot of government debt. They're out there in the market. High growth and inflation expectation. Number high. Does that make sense? Okay, keep that in mind. So when you see low nominal rates, growth may already be weak. Growth is weak, and the rates are the reciprocal of that. And any monetary policy that chases that is 6 months late, reciprocal of that, right? So think of the US in the 1970s. Nominal rates were very high, but inflation was very high, meaning monetary policy was still quite loose. And this is if you believe that monetary policy does anything. We have to, at least for this discussion, just assume that monetary policy means something, which we know it doesn't. But for the sake of this discussion, you have to pretend, okay, if there was monetary policy, under what circumstances would it be where it's at? So you contrast the 70s, where you had high inflation and rates. You see, at high inflation, rates were high, right? Technically loose monetary policy. With the 80s, under Volcker, where to try to wrestle down inflation, this is at least the myth they will tell you, rates were high, but inflation was collapsing because policy had been tight for some time. Now, why did rates collapse? Well, it didn't have anything to do with policy. They tried everything. They still don't know if any of what they did worked, or if just business cycles kind of, did their magic, right? Like things don't stay high forever and things don't stay low forever. So what are these cognitive biases that keep this interest rate fallacy alive? So availability bias, which is we remember that rates went up and inflation fell. So there's some weird cause and effect loop. We're ignoring all of the lag times and all of the context around it. We just remember, Volcker raised rates and inflation went down. Right, not at the same time and not even correlated. And that wasn't even their intended effect. They had no clue that's what was going to happen. They just later looked back and went, because he did that. Volcker himself didn't know what happened. Then you have the causation illusion, where humans are wired to think that if A precedes B, then A caused B. A dangerous shortcut in both macroeconomics and logic. Because something happens first doesn't mean it caused it, right? I ate breakfast before I went to the gym and saw someone break their neck on a bench press. Therefore, breakfast made the guy break his neck. No, that's stupid. That's how humans think. That causation illusion. Dumb. And then confirmation bias, which we all know. Obviously, policymakers, media commentators, they cherry pick data that fits the sample, high rates equal tight money narrative, right? So you have to steer away from the availability bias, the causation illusion, and confirmation bias. The game theory angle is the central bank's signaling game, their political theater game, is corrupted because the signal, which is interest rates, is noisy and it is delayed. Okay, market players you have to try to interpret all this stuff, but what happens is market participants typically misinterpret the move, which changes their strategy. So they think that the Fed can do something. So they're looking at it with the wrong kind of causation. They're thinking that Fed policy moves the market to do certain things, when the market does certain things and then the Fed chases it with policy. Right? We're going to lower rates. Well, they're already going down. We're going to lower them. It doesn't matter what you do. They're going down anyway. And this is what happens. This is why an inverted yield curve is such an embarrassment to central bankers, central planners, because they look at this, they go, but we didn't say this. We didn't invert the yield curve. Yeah, no shit. You don't do anything, much less this. The yield curves invert when inflation expectations show up in the bond market, right? It's a source of truth, that yield curve. So you got to you have to make sure that you understand that central banking is a reaction to markets. It is a reaction to behavior. It is a reaction to everything that's happening. It is not the cause. It has never been the cause. Meaning, It can never fix anything in the market because it never caused anything to be able to fix anything. It is a reaction. You put your hand on a stove and you go, ow. The ow didn't create the burn. Okay? So now when you talk about expectation theory and its really flawed grip in the human psyche, and this is the one that this is, for whatever reason, these economists are just anchored in this stupid thing. But this sticky, we'll call it stupid, sticky belief in the mind of the typical economist is expectation theory in inflation. The theory basically states that if people expect higher inflation, they will act in ways that cause higher inflation. You want to know how much data there is for this? Nothing. Ever. Like, when I say ever, I mean ever. Nothing. Fucking goose egg. Right? The same amount of scruples that the team at Ripple has about selling tokens underneath the market price against you and then lying about it on CNBC. Same amount of scruples. Zero. So if people, but again, this is the theory. This is expectation theory. If you expect higher inflation, you will behave in ways that cause higher inflation. Sounds neat. Sounds like a self-fulfilling prophecy, but empirically, it is wrong. There have been really long stretches where inflation expectations were stable, yet inflation rose, like 1973, the oil shock, supply chain disruptions, COVID, all these, right? So, and then there are times when expectations were high, but inflation fell, like the early 80s, the disinflation, even though, a bunch of people were still fearing inflation. And people have been, look at all the money the government prints. It's a lot, okay? And where is the runaway hyperinflation that everybody's Zimbabwe, fucking, it's not here. People still buying government debt like it's going out of style. It's still the most attractive option in the world. So you would say, okay, why with not just a little empirical data, but all of it, would people that are sophisticated academics, economists, Fed governors, Jerome Powell, why do all these idiots, why won't they let it go? Why won't an economist let this thing go? Well, they've got a couple of biases themselves. Other than the other biases we talked about, they have something called model fixation bias. They have status quo bias, which you can guess, and they have social proof bias. So their model fixation bias is once a framework is in the DSGE model, right? It is very hard to remove without breaking the entire structure. Meaning they have a model which they use to look at the world, their kind of economist framework, okay? And they learned this when they went to school, when there was black and white television, or even before black and white television, way before cell phones, certainly way before the internet. When things made sense. And they have this model, and if you made the model honest to the world that we live in, it would break. And then you have a whole class of people that were educated in nothing. Imagine, again, you're the expert in nothing. You spent an entire life studying fiction. You might as well be preaching, Scientology? Same shit. This is a work of fiction. DSGE model is a work of fiction. Okay? Then you have status quo bias. Central banks, central bankers, economists, they have invested decades into surveys and break-even inflation metrics. And if they abandon them, they are at sea without a compass. And it doesn't matter that the models don't work. It doesn't matter that they're broken. They have models. They're like, we have the Phillips curve, right? But it doesn't work. But we have it. Yes, but it doesn't work. It doesn't mean anything. And it's not even a curve. It's a random distribution of dots. There is no curve in there. It's a curve. We use it. But it's not even a thing. Where's the steering wheel? It's just a series of buttons. How do you turn? You just start touching buttons. But how do you turn? Status quo bias. And then social proof bias. Basically, if you're a central banker or an economist or a scummy teleprompter reader on CNBC or CNN, or just go through the list, Bloomberg, any of these, where there's some financial media involved, if every other media person or economist says the same thing, and if they believe it, well, if you don't believe it, if you stand up against the what looks to be whimsy, you got some career risk, right? You're the one that stepped out, so you broke ranks. Never mind a fixation on broken old models that don't apply to the real world. Never mind decades of pointless and useless surveys and break-even inflation metrics that do not work. Never mind all of the data that you use being flawed. If you stick up and say, hey, this doesn't seem right, all of the other people that don't have a choice but to believe in the myth, you will be ostracized. So expectation theory assumes a coordination game, basically a stupidity coordination game, where everybody's inflation expectations align and they dictate behavior. And in reality, inflation is influenced by multiple overlapping games: commodity markets, labor bargaining, fiscal policy, capital flows, short-term political events, wars, skirmish, cartels. Assuming a single expectation equilibrium oversimplifies the complexity of the world that we live in. And if you grew up during black and white television, you're just not capable. That's it. This is too much for you. It's okay. Economists of the world, you have aged out, embarrassingly so. So why this matters for us is because when you hear the Fed is raising rates, so they're tightening, you want to pause and you want to ask, wait, what's the real stance of monetary policy? Meaning, what are people doing with money? Go to the bond market, take a look at inflation, look at credit conditions, look at the quality of collateral in the system, look at liquidity flows, cash, credit, and quality collateral. CCQC, baby. Cash, credit, and quality collateral. That's what the fuck the economy is. All of this other stuff is bullshit. So when you hear inflation expectations are anchored, ask, well, does that actually predict future inflation, or is it just a weird blanket for dumb economists that don't know what the fuck's going on? And misreading these signals, it leads you to really bad investment moves, right? Selling too soon into a rally because you think a rate hike is going to kill the market. Hikes, cuts, they don't mean anything. They don't do anything. Like literally nothing. Overestimating inflation risk because everyone's talking about it. Oh, here, this is the, even Ray Dalio and these guys. Oh yeah, this is unsustainable. You know how long people have been talking about government debt being unsustainable? From the beginning of government debt. From the very first time there was a bond auction, probably. Oh, this is going to get out of control. Milton Friedman's fallacy is really a warning about misinterpreting noisy signals with bad math in a delayed feedback system, with poor reporting and terrible reliance on all of that. Like just the BLS, you don't have to look further than the BLS. And there's still people that will defend it. Well, you need some number. No, you don't. Not if it's a bullshit number. If a number has to be revised down 60, 70, 50% every time, then wait until the revisions before you publish the motherfucker. Otherwise, you're lying to everyone and then the revisions. Oh, no. Speak up. Speak up, little Lord Fauntleroy. So one of the things that game theory is really great at modeling is human behavior, right? And so the fixation on expectation theory is a reminder that economists and their ilk get stuck in intellectual equilibria, even when reality has moved on by decades. The best players in the macro investment game aren't the ones who read the signals. They're the ones who decode them before the rest of the participants decode them. And that's why doing a little bit of work right now, doing just a little bit of work, puts you way ahead of everyone else, because no one else is considering this stuff. No one else is taking the time to think about this stuff. So if you are, you're going to win. You're going to win even accidentally. Let's see. Would you give some explanations about the Federal Reserve? Or wait, I'm not sure what I'm reading. Over and over and over and over and over. Don't you ever get tired of the same old rant? Frank, buddy, if you already know all this stuff, this should be a good review. Should be a good review. Frank, when was the last time you dug deep into the cognitive biases associated with interest rate fallacy and expectation theory? Fucking never, Frank. You've never done it. You may have heard of it. We've all heard of it. But until you dig in, and I'm just busting your balls, Frank, because you let me bust your balls. And Frank is a good sport. Frank lets me bust his balls without crying. Frank busts my balls. I bust Frank's balls. Not to assume Frank has balls, but we're allowed to now because Trump is elected. Before, I would have had to not make that assumption. But now I'm going to assume Frank's got balls. Therefore, I shall bust those. Anyway, you have to dig into the way that you think about this stuff. It isn't just that this stuff occurs and you can't pay it lip service, meaning you can't just go, okay, these economists, these guys at the Fed. Why? Because that's who's influencing the people that every one of us are competing with in these markets. That's who we're competing with. We're competing with people that believe expectation theory, that believe the interest rate fallacy. And if you don't have it locked, then you're not going to be much ahead of that pile of people. The only thing you got going for you would be that you're doing the research and they're not. But the conclusions are pretty dramatic, so that when you look at the macro economy, you have a better read on it and you make better decisions because of it. Frank, quite frankly, anyway, busting your chops, Frank. Yeah. So keep these things in mind. Behavior of bond traders proves interest rate fallacy and expectation theory. Yeah. The truth is in the bond market, man. Is it boring? Yes. Is it kind of a headache to wrap your mind around on a regular basis? Yes. Is it kind of a through line of what's really happening with cash, credit, and quality collateral? Absolutely. You got to pay attention to this stuff. And then don't get sucked into those cognitive biases, which everybody else other than Frank is learning. Frank already knows all these, but everyone but Frank, you now have more psychological ammunition at your disposal. Let's hope you just don't run up on Frank on the street and get talked down. As subprime melted down in 07-08, Wall Street execs reportedly said that their models indicate there's no correlation between package loans. Yeah, God, The Big Short. Yeah, Steve Eisman. Yeah, your models are wrong. Yep. You know who? Yeah, who else? Who else basically just shut him up? Remember when Michael Burry was trying to get Goldman Sachs to write a bunch of default swaps against the housing market, and they're like, but the housing market is never. He's like, so many people would have to lose their loans, and those things would have to get adjusted, and they'd lose their houses and all this kind of stuff. Those bonds would have to. All those bond packages would have to be destroyed. He's like, that's never happened. And he's just like, you're wrong. And then they were like, shit, well, okay. If you want to gamble against a thing that's never happened before, we will sell you. And he ended up buying hundreds of millions, I think, when it was all said and done, hundreds of millions in commercial default swaps against the housing market, against all those loan packages. Pretty cool. They're like, how do you know? He's like, I read them. Like, what do you mean you read them? I read them. You read the bonds? Like, no, I read the loans inside the bond packages. Holy moly. That guy did the research. Guess what he got as a reward? Billionaire status. He got billionaire status. There's billions out there. And listen. Linda, listen. Warren Buffett wasn't a billionaire till he was 56. So there's still time. Anybody here that wants to be a billionaire, if you're not 56, you can still catch, you could theoretically catch and surpass Warren Buffett. Okay? Now, if you're over the age of 56, you might not catch Warren Buffett, but you might still be able to be a billionaire. So don't cast yourself out. Everybody here still got a chance. Anyway, we'll see you guys tomorrow. Stay in school. Don't do drugs. Don't do anything by poor, insolvent, drunk, strung out on meth, grifter, ass grandmother, or Brandon wouldn't do, which is very little. And we will see you tomorrow.
Killing time, no place to go. Everybody's feeling low. All alone in the street like glow. You fall into your head. It's all that you want. It's all that you need. Take some time to make believe. It's all that you want. It's all that you need. Just some time to make believe. It's all that you want.